Hello, and welcome to Varm Vlog. And I'm going to be discussing a lot of things in this kind of special edition of the solo show. It's a special edition because it requires me to go over recent news that I can't fit into my long-term schedule. I'm going to be referring to a couple of different pieces today, and so I'm going to tell you what they are, and you can find them again in the show notes. I am going to be pulling from a video by Max of UNFTR, Progressive News Network, who released a economics rundown video on the macro take on the Midas Touch Network, kind of the bellwether of progressives right now. I'm also going to be talking about the Snyder report from the end of January and the gold and silver facts. And then I'm going to tie that into some more recent economic discussions by Adam Tooze, particularly his February 11th chart book entry and an interview he did with the Burning Archive. And lastly, I'm going to tie all that into a piece of scholarship by Alami Chador and Taggart that came out on the 12th of February of this year. You will find citations with links in the show notes. There's a lot to talk about here because, as I've complained about the government basically being an insurance company that kills people, I can also say we are in a time period where the U.S. economy is a hospital that has nukes. The Dow and the S&P 500 have been doing relatively well, but almost all off the market cap growth of AI. There is beginning to show signs of weakening in this sector that people have been predicted for about a year. I mean, Ed Citron's been predicting it since all of this started, and it's been slow to manifest. But it's beginning to play out like the 1970s devaluation of the big cap stocks too. There's a lot of reasons to note why this is the case, and I've talked about it before. The funding and research and development that led to the growth of AI was largely brought onshore during a small allowance to reshore a lot of offshore accounts in the end of the first Trump administration. And that has been what a lot of the money for this R&D has gone into. The development has been bizarre because the actual end products tied to AI have not been particularly profitable. But it has led to GDP growth because unprofitable investment still shows up as investment. And furthermore, there has been profitable investment in chips and in data centers, the physical hardware. Now, I could be a vulgar Marxist and just say this proves a lot of my point about the physical economy still being the undergirding necessity of the rentier economy. But there are a lot more stuff to look at here. So we have a major cooling of labor. And in fact, one of the things that we have to deal with today is that pretty much since the 2025, our economic statistics get revised every few weeks. The last revision, since January 2026, saw 108,000 job cuts, which is 118% from the previous January and a 200% decrease over December, which admittedly December is Christmas, and so the Christmas spending usually keeps that job numbers and somewhat higher a raise even in a bad economy. Private employers only added 22,000 jobs in January. That's anemic. Total jobs added was actually significantly lower than the 771,000 jobs added during the last year of the Biden administration. We have noticing a trend of job openings going down about 400,000 to 6.5 million job openings, with a year-over-year opening turning down by nearly a million after revisions. This is interesting, particularly when you look at specific sector failures. Despite all the initial Trump talk about reshoring America, we have seen the trade imbalance grow. We've also seen 70,000 manufacturing jobs lost. This is despite Trump talking about a deliberate policy of debasing the dollar to boost the domestic industries and exports, which should work, but isn't. Tourism has been slowly cratering for 2 years. International travel to the U.S. has dropped by 4.2% in 2025, and that's led to a $50 billion loss in spending. Our reputation for dealing with immigrants and even guests has really hurt tourism, and that is despite the fact that a weaker dollar should mean that tourists would be more likely to come here. Lastly, most job growth is in education and healthcare, with healthcare far predominating. We have an aging population, mostly in the baby boomers, and we have health problems amongst Gen X and even millennials that are contributing to the growth of the healthcare market. But the healthcare market is not particularly productive. This can spike up GDP, but this does not show any productivity growth in the real economy or even in rents. Bond trader Rick Reeder says that GDP looks robust; it's over 4%, but they're concentrated in capital flows and wealth savers. So this is literally a capture of real tangible capital that is spiking GDP growth at the expense of pretty much most of the population. The quote real economy unquote, which is lower middle income workers, even small businesses, is struggling with increasing debt burdens and declining work hours. And it's not clear what's causing the decline. AI is contributing to it, but it's not the only one. If we think about this, there's something called gifts of the Trump economy, and this was pointed out by Max from UNFTR, they're in areas that are actually getting hit. So if we're working less hours, the no taxes on overtime, which was only no taxes on a third of overtime anyway, isn't going to help most blue collar workers. And if there is no taxes on tips, but hospitality is now only booming in the high-end sectors, with fast food and middle-income dining beginning to just tank, and there's also very little tourism to the United States because of our international reputation, that's not going to really help people either. Now, those are a bunch of macro views there, but when we get into some bigger problems, and this is, we're going to turn to the Snyder Report. At the end of January, gold dropped its value 34%, falling from a high of $121.70 per ounce to about $85. Gold tumbled more than 10%, losing roughly 12.1% of its value in 3 days. Now, this doesn't just affect the US, because BRICS countries have been stockpiling metals themselves, seemingly to deal with a transition to a new Forex currency. And until that's settled, and it's, the yuan or whatever we propose it be, you're going to be stuck with a 19th century scenario where people are trying to back their value in a universally accepted commodity that is not easily just burnt up, and that is metals. That led to a market cap erasure of about $5.2 trillion and $2.2 trillion in silver within 72 hours. Bitcoin also collapsed. So cryptocurrency is seeing its own devaluation. It fell from highs of 125,000 per Bitcoin to 83,000, erasing over $800 billion in value. This isn't probably going to change. At the end of January, there is the wash effect, since all the craziness around the Fed led to Kevin Walsh being floated as possible Fed chair. He is viewed as hawkish, and this implies he may keep interest rates for longer to combat inflation, which typically hurts non-yielding assets like gold and silver. And the reason why it hurts that is because why are you going to offset bonds with metal if the bonds are valuable? However, the international value of the bonds are questionable anyway after Trump's big stunt with Greenland. And we know that Walsh is historically more concerned with inflation than other economic indicators, because that's where he was when he served on the Federal Reserve Board during the 2008 crisis. Now, it's weird that Walsh would be one of the people that is nominated by Donald Trump, considering Donald Trump wants a lower interest rate and maybe even an inflationary borrowing conditions. So what's going on? And even I'm not entirely sure. There are economic implications, though. Higher for longer interest rates mean that mortgage rates, auto loans, and credit card interest will likely remain expensive for the near to short term, with burgeoning debt being an issue for most Americans. The national debt is already getting hard to service. Higher interest rates will increase that cost, period. When you have a debt over 30 trillion, higher interest rates increase the cost there. Now, we can go into the MMT versus conventional economics view of how you pay that out and whether or not that really demands taxes and overheads. And I think that's a fair question. But the issue is not who's owed money by the US in the country, because you really can autarkically handle that, but how bondholders outside of the country handle it. Now, bondholders outside of the country are not a majority of bondholders, but the international markets have a huge effect here. Stuff like the tariff dividend, you can just throw that out now. I mean, there's almost no way that anti-inflationary Fed would really encourage that. Plus, that always seemed to me to be a thing that Trump floated with no real support, even in Congress. We've had metal crashes. Dollar stabilization has been slightly upticked since it's been in crisis mode in the beginning of 2026. You have a transitioning of investments, and it seems like we have watched people overpay for these peaks in commodities, particularly silver. Now, this leads to extreme uncertainty regarding tariffs. The Supreme Court is still delaying its decision there. There's also been moves for Congress to strike back, with Republicans actually siding with Democrats to make reversing Trump's tariffs an open question, and there are increasing layoffs. There's a lot to look at here, and that's before we even get to the problems around the tariffs and peak tariffs. Now, Adam Tooze is been good at pointing out that the Gilded Age nostalgia that Trump is often trying to allude to, based on high tariffs, is based on one, a different economy that we have now, and two, uh, it wasn't really the McKinley era that led to the highest tariffs. It was the isolationist era in the late 1920s and early 1930s, which did tie with the Great Depression. Tooze has been arguing that we have reached a saturation point where the economic cost of consumers outweighs any national security gains made by reshoring, and that there has not been enough domestic production to really offset everything. China now holds 32% of all global manufacturing, and that isn't likely to change. While China has its own economic die downs to deal with, it is still the manufacturing powerhouse of the planet right now. This leads me to think about a few different things. Are we moving into an area of a new economic hegemony, or are we moving into economic multipolarity, or what people like Alami, Chidor, and Taggart have called non-hegemony? One, we've seen massive institutional decay. The World Trade Organization has been intentionally hollowed out by its member states. You have a security first finance and the rise of DFCs. You have multinational bodies everywhere from the UN to the IMF being forced to serve narrow national and even elite economic interests. They always served elite economic interests, but now they're being used as national weapons. And you've had the hollowing out of various soft power organizations within the US, internationally, such as our relationship to the World Health Organization and our complete defunding of USAID. Now, liberals have made a lot of hay about this, but this actually does indicate something that people like Peter Zion and John Mersheimer, from the two different views of realism, the aggressive and the liberal, have been pointing out for a while, is that the US was going to strategically disengage with being the world police that maintained blue water trade by themselves largely. You can also see that in the strategic underfunding of the United Nations by the United States under the second Trump administration. So there's been a lot of talk of this being a second Cold War, but it's not clear what the real ideological differences between these various states are. I mean, China is nominally socialist and is developing towards whatever socialist reforms it needs to do, but it is operating in a worldwide market global economy. It seems like increasingly that maybe Robert Brenner wasn't totally wrong, that we live in an age where political involvements over monopolies are really deciding who controls strategic networks such as chips, green energy, and finance. And thus, you have a low profit environment on manufacturing and key commodities and a high profit environment for rentiers. But that rentier value has to come from somewhere. It can't come from nothing. And thus, a central contradiction. Now, there's a lot of different ways to deal with what we want to do with. Here, I think there's some things that we want to look at that point out some problems and Marxist analysis that aren't necessarily easy to handle. And what do I mean by that? Well, is this a temporary policy shock from the Trump administration? Is this an end to neoliberalism and a new phase of capitalism? Or is this a global crisis of value? And I, for one, actually cannot tell you. I would love to be able to give you a certain historical interpretation that you could just use, but I don't think we can do that. There are several contradicting interpretations based on the facts, particularly around the gold and silver crash, the Kevin Walsh nomination, and the AI capex surge and its limits. One, and these are traditional Marxist explanations that we run into all the time. There's a interpretation around the tendency of the rate of profit to fall versus underconsumption. The tendency of the rate of profit to fall view, which would be a relatively orthodox Marxist view, would argue that $650 billion in AI capex represents an increase in the organic composition of capital. That is an increase in fixed, not variable capital, which means all kinds of things downstream. By replacing living labor, which is variable capital and thus a source of surplus value by its exploitation rates being able to be changed, with accumulated or dead labor, which is prior labor being put into AI and machines, corporations are crushing their own profit rates. Now, is that actually true? This is one of the biggest debates in Marxism and has been for most of the 20th century. The market panic and layoffs aren't just erratic behavior. According to this view, what we are seeing is the system's way of purging excess capital to restore some notion of profitability or to set up more monopolies for research capture. But the problem is there's got to be resources to capture. There's the underconsumptionist view. Both modern monetary theorists, Keynesians, and Marxists influenced by Baran and Sweezy would argue is not just a falling profit rates, but a lack of demand. They would argue that a $50 billion loss in tourism and the struggle of the working class world economy is evidence that capital is piling up at the top with nowhere to go. In this view, the AI race is a desperate attempt to find an outlet for surplus capital that the masses can no longer afford to consume. And one of the predictions this would lead to is you could kick this back off by stimulating consumption and spreading the wealth back around, thus making this a policy issue. Now, MMTers would definitely agree with this, but they're not the only ones who would be under consumptionists. What you can see here, though, is that these aren't really talking about the same things. What you have to deal with is the monetary value actually representative of real value, and that's not clear in the stats when you're in an inflationary or deflationary environment. We have to look at this in a way that kind of gets out of these two problems, because on one hand, it is very clear that we are in a K-shaped economy where consumption is having trouble spreading the wealth around. But it's also very clear that it doesn't look like there's a clear policy instrument to enforce that. It is true that physical commodities have seen declines in value and profits, even at a highly leveraged economy. Particularly if you look at sectors where there just frankly aren't a lot of intellectual property rents tied into the ability to raise prices. I mean, look at food, for example, or oil. You know, we also have to ask ourselves what other problems this may lead to. There's the TSSI interpretation of Marxism, which is the temporal single system analysis often favored by people like Andrew Kleiman. If we look at the crash in gold and silver, which is $7.4 trillion of loss, this value adjustment reflects an actual state loss of value, total value in the system. They would argue that if AI is devaluing the hardware and clerical labor of the world, the money commodity gold must eventually reflect this loss in social value over time. It's not going to happen immediately. There's another way to look at this, though, which is the neo-Ricardian view, that the gold crash and the Walsh nomination are purely a distributive crisis. In this view, the Fed isn't responding to value, but is actually using high interest rates to discipline labor and favor finance over industrial capital, regardless of what happens with AI productivity. So again, you have a question. Is this a objective law of capital that is irreversible, or is this a policy issue? I'm going to suggest, just like with the view of this in the tendency of the rate of profits to fall and the underconsumptionist contradiction, we are actually seeing where traditional Marxist binaries of interpretation are limiting us, because there are distributor struggles tied into bond markets. That is absolutely clear. And I think I've made that clear in much of my work on the way bonds can be used to limit education, et cetera, et cetera, et cetera. Now, I'm not going to touch into whether or not this is neo-feudalism or accelerated capitalism, but I can tell you people will bring this up because of the increasing role of rents. Uh, Scholars like um, Jody Dean and maybe even Mackenzie Wark might interpret the asset-oriented economy and the dominance of capex and tech as a shift away from capitalism towards something else, since these are only possible through extractive rents or through control of vectors. But I'm actually not sure that we're not just seeing capitalism as usual. One, rents are part of capital going all the way back to the origins of capitalism. And two, um, if we look at the volatility of things like Bitcoin, what we see is fictitious capital bombs. That does not indicate that the rent extraction can support the entire economy, inevitably, because techno neo feudal rents or vectoral rents or whatever do not actually operate like ground rents do in feudalism. Lastly, and we have to get to this, is one, how much is the gold and silver crisis actually a return to traditional commodity markets for money as a universal equivalent, replacing forex? And how much is this just an attempt to stabilize the dollar by policy and by competing economic actors who do not have a historical claim to being a dominant part of the forex basket, but do have a developing economy which would justify it? Now, the issue with the chartalist uh, Marxist view and the MMT view is that you have to square that off between the fact that the US government doesn't really set prices on the international market, despite what Warren Mosler may say. And two, the commodity money view just has the problem that money hasn't been backed by a commodity uh, for a little while. Even if you buy that the commodity moved from gold to silver to the petrodollar in the 1970s, this is not true today. Now, you could argue that is finally why you're seeing devaluation of the dollar and a crisis in the shift of forex, but I don't know that this actually settles the question on what commodities really back our money. And citing Marx and 19th century economists aren't going to get you out of the need to answer this objectively. There's a few other things that we need to look at. One, we might be in a post-data Federal Reserve. Kevin Walsh has actually explicitly criticized the Fed's traditional reliance on historical data. Walsh argues that inflation is driven by government spending and money supply growth rather than by wage growth, which, is interesting. This is a radical departure from the Phillips curve logic that dominated the Fed for decades. Walsh has also suggested that AI is a powerful deflationary force that creates a productivity wave similar to that in the 1990s, but we haven't seen that, and we didn't really see the 1990s internet boom lead to permanent productivity wave either. This, despite Walsh being a historically hawkish on uh, uh, interest rates, this actually indicates that he could actually be in line with Trump's view. So what's being left out here? Um, Decline in tourism is not just an issue of the popular opinion of the United States either. Um, there are new regulations that went in place this February that require visitors from 52 countries to provide 5 years of social media history, phone numbers, and detailed family information, medical history, and even genetic history if it's available for their biomarkers. That's nuts. Travel experts also note that intrusive data requirements are creating a digital barrier, making you feel closed off. So we've seen a even larger drop from key markets, a 29% drop in the summer 2006 bookings from France, for example, being a key indicator. Lastly, we are moving to an algorithmic driven crisis on how information is discovered that affects all kinds of things. I haven't talked about it. The Washington Post laid off a ton of people in its media apparatus. And the Post leadership has noted that organic searches, have declined nearly 50% in 3 years. That means that people aren't using search engines to find primary articles, but instead are depending on AI glosses. We also have the fact that social media has tried to enclose its infrastructure, kind of like the states have, which have led to information barriers across the board. What you get is driven more by algorithm than even your search terms. So, in light of all that, then we have to deal with what's come up in Tooze's work. Digital assets are a major problem right now. It seems like they're permanently downturning, but it might just be a blip. We've seen blips in Bitcoin and stuff before, but we've also seen moves like the Chinese state looking to more regulate crypto. At the same time, where you have people from the United States government claiming that we're going to move to an all crypto economy eventually, which is kind of nuts. You have tariff saturation because there might not be a strategic benefits to aggressive tariffs anymore. And this may plateau to an economic crisis as economic costs to consumers and supply chains outrate any perceived security advantages are reshoring that is obviously not happening. If we look at this in the long term, this is proof of Tooze's polycrisis actually being a long historical view, which that we should be looking at, which may actually lead us to consider a few things. Even though Tooze is not anything like an orthodox Marxist, it would lead us to wonder: should we be thinking about this in long historical terms? Now, I obviously think we should, but we'll come back to that. So, if we look at all these things together, we have a few key points. Is this market breakdown in the West a sign that Western hegemony is over? I think actually, people have been talking about that in terms of the United States, but I don't think it's just the US. True multilateralism tends to be the Chinese vision. Sometimes this gets also phrased as multipolarity when people are being more interested in geopolitical realism. Are we entering a permanent state of fragmented market warfare between states? I don't know. And neither the most of the people commenting. Is the state cannibalizing social and ecological points to maintain what little bit of wealth it can? I don't know that either. Should we be looking at geopolitics or production? This I can say, we can be clear that geopolitics is both downstream and upstream from the economy. It is upstream from most of the things we want to do domestically. The limits that we have are often international law, international markets, and trade barriers. But it's downstream in the sense that ultimately profitability is what is driving a lot of geopolitical tension. What do you make of that? Any serious Marxist today is going to need to look at this and try to parse it. And while I went through the various interpretations that have come up and, and like late 20th century Marxism, it is clear to me that a lot of these binaries don't really give us clear answers. Maybe it's time that we grew up, pulled up our big person pants, and started doing the work again instead of just rehashing a long litany of this theorist or that theorist. And on that note, protect your peace. Like and subscribe, hit the bell. There's more behind the Patreon wall, and hopefully I'll be doing more of these kinds of shows. I am still getting used to making sure I have all my economic facts outlined. So if I feel a little bit like I'm reading from a teleprompter, I'm not, but I am checking myself because I have been confusing in the past. Like for example, there's a time where I mentioned that the Irish GDP per capita, and I forgot to say that part, had increased the British GDP per capita. The British GDP is in absolute numbers higher because the population of the UK is higher. But the per capita numbers for Britain are quite bad and continue to decline. So, the United States, a hospital with nukes, with a government that's an insurance company that kills people. Lovely. This is America. Protect your peace.